It's 7:14 a.m. on a Saturday. You're standing in a stranger's kitchen, trying not to look too interested. The listing agent is watching you like a hawk. 2 years ago, you'd have signed anything just to get in the door. Today, you've got options. And that changes everything. This is the 2026 housing market. And if you know where to look, it might be the best buying opportunity in a decade. For years, buying a home meant waiving inspections, bidding 30 grand over asking, and praying you'd get a call back. The sellers held all the cards. But here's what's changed. Inventory is climbing. Homes are sitting longer. And for the first time since 2019, buyers have real leverage. Redfin calls it the Great Housing Reset. And today, we're breaking down exactly how to take advantage of it. Let's start with the mortgage rate picture. Because everything, your budget, your negotiating power, your timeline, flows from that single number. As of March 19, 2026, the 30-year fixed mortgage averaged 6.22%. That's according to Freddie Mac's weekly survey, the industry benchmark. Now that's down from the peak we saw in late 2023 when rates touched 7.5%. But it's still historically elevated. Here's the projection that matters. Analysts expect rates to ease toward 5.9% by year-end. That's not a promise. It's a consensus forecast. But rates don't exist in a vacuum. Just 3 days after that 6.22 reading, geopolitical tension pushed them to 6.53%. Markets move fast. So the question isn't just where rates are today, it's whether buying now with negotiating leverage beats waiting for potentially lower rates and stiffer competition. The National Association of Realtors is forecasting a 14% nationwide increase in home sales this year. That's significant. More buyers means more competition. And prices aren't falling. NAR projects a 4% increase in median home values. So waiting could mean paying more later. But here's where 2026 gets interesting. Because while demand is rising, the supply side is shifting in your favor for the first time in years. According to the mortgage reports, 40% of builders cut prices on newly built homes at the end of 2025. Average reductions? Around 5%. And it gets better. 2/3 of builders offered additional incentives. We're talking mortgage rate buydowns, closing cost credits, upgraded finishes. Rate buydowns are where this gets tactical. A builder pays to temporarily reduce your mortgage rate for the first few years of the loan. A typical 2-1 buydown drops your rate by 2 points the first year, 1 point the second, then levels out. That could mean saving $300 or $400 a month early on. If you're considering new construction, you might want to ask specifically about rate buydowns. Many buyers don't know these exist, and builders don't always volunteer them. Now, let's talk about something most first-time buyers overlook entirely. The type of home you're targeting could be limiting your options. Here's a number that might surprise you. Townhomes now account for 18% of single-family construction. A decade ago, it was under 10%. Townhomes typically run 15 to 20% cheaper than detached single-family homes. For a first-time buyer stretching to afford entry, that math matters. Consider expanding your search to include townhomes or attached units. The lower price point often means you can get into a better location, and location holds value. All right, let's get into the money moves. Because strategy in this market isn't just about finding the right house, it's about financing it smart. Rocket Mortgage Analysis found that borrowers who compared quotes from just 3 lenders saved an average of $80,000 over the life of a 30-year loan. That breaks down to about $222 a month. Every month. For 30 years. Just from shopping around. That's not a strategy, that's a requirement. Before you tour a single property, consider getting quotes from at least 3 different lenders. Credit unions, online lenders, traditional banks cast a wide net. Now here's something even more overlooked than rate shopping. Down payment assistance programs. They're everywhere, and almost nobody uses them. First-time buyer programs exist in nearly every state and major metro. Grants, forgivable loans, matched savings, real money most buyers don't know to ask about. You might want to search for down payment assistance in your state before you start house hunting. Some programs have income limits, first-time buyer requirements, or specific property criteria. Here's where we need to talk about something people don't want to hear. The debate about whether to buy now or wait isn't simple. If rates drop significantly, up to 1.6 million additional renters could become eligible for homeownership. That's according to NAR. That's a lot of new competition. Buy now, and you might lock in a higher rate but have more negotiating room. Wait for better rates, and you could face more buyers and higher prices. Some experts suggest ARMs, adjustable rate mortgages, as a middle path. The mortgage reports notes they can provide near-term affordability while you wait for rates to settle. ARMs can make sense as a short-term strategy, but they're not for everyone. Consider consulting with a mortgage professional about whether the risk profile fits your situation. Let me give you a framework for thinking about this, because the right answer depends on your specific timeline and risk tolerance. 1 approach. Calculate your monthly payment at today's rate, then compare it to what you'd pay if you wait 6 months, factoring in a 4% price increase. If waiting could cost you more in home price than you'd save in rate, the math favors moving now. Run those numbers with your specific budget before deciding. Now let's talk about what the market calls the most balanced conditions in almost a decade. What does that actually mean for you on the ground? Redfine's analysis puts it bluntly. Buyers have more leeway while sellers have to be more flexible. That's a quote. After years of sellers calling every shot, the power balance has shifted. In this market, consider asking for things you couldn't before. Inspection contingencies, seller-paid closing costs, repairs. The worst they can say is no. Here's the honest reality check. Even in a more balanced market, housing affordability remains challenged. The fundamentals haven't magically fixed themselves. The median home still requires a higher income than most first-time buyers have. Housing economists agree. The only real solution is building more homes. We're not there yet. But here's the thing about affordability challenges. They affect everyone in the market. In a balanced environment, your competition is struggling with the same math you are. You might consider this. Being well prepared, with your financing lined up, your documentation ready, your budget clear, gives you an edge when everyone else is scrambling. Gather your documents now. Tax returns, pay stubs, bank statements, proof of assets. Having these ready means you can move fast when the right opportunity appears. If you're finding this useful, hit subscribe. We cover strategies like this every week. Now let's wrap this up with the tactical summary. 1. Shop at least 3 lenders. That $80,000 average savings over the loan life isn't theoretical, it's documented. Don't leave that money on the table. 2. Explore new construction. Builder incentives like rate buydowns can save you hundreds monthly in the early years. Ask specifically what programs they offer. 3. Research down payment assistance before you start looking. State and local programs exist that most buyers never discover. A quick search could unlock thousands in grants. 4. Expand your search. Townhomes at 15 to 20% below detached prices might get you into a better location, and in real estate, location compounds. 5. Negotiate. This is the most balanced market in nearly a decade. Ask for inspection contingencies, ask for seller concessions, ask for repairs. The dynamics have changed. Now your situation is specific to you. Your risk tolerance, your timeline, your local market conditions all change the math. You should absolutely verify any strategy with your own financial advisor. But what the data shows and history suggests, though it doesn't promise, is that prepared buyers win. Non-liokia rate to frosted housing market. But for the first time in years, it's a fair fight. And that's something worth paying attention to. Remember, this content is for educational purposes only and doesn't constitute financial advice. Always consult with a qualified professional before making major financial decisions. I'm Money Moves Daily. Stay informed, stay strategic, and we'll see you next time. Remember, This content is for informational purposes only and is not financial advice.